Hello everyone, welcome back to the channel. Something very important happened beneath the surface of the financial system, and it directly impacts the health of the United States banking system, and it exposes the growing weaknesses of the system. While markets were distracted by year-end rallies, holidays, and rate cut speculations, the Federal Reserve very quietly injected tens of billions of dollars into the United States banking system. For example, on December the 30th alone, the Fed supplied $16 billion in overnight liquidity. The move marked the second largest repo operation since the COVID crisis. Believe it or not, by the end of the month, total December repo injections reached just over $40 billion. Now, on paper, this might look boring and very technical. However, you and I understand that when the Fed steps in at this scale, in simple terms, when it chooses to intervene at this scale, especially outside of a crisis, this is usually regarded as a response to stress that isn't immediately visible. These funds were provided through overnight repurchase agreements, or repos, as I just mentioned. And this is where banks and financial institutions temporarily exchange Treasury securities for cash. This is done overnight officially. The purpose is to keep short-term interest rates stable and to ensure smooth functioning of money markets. Now, that's the official story. What's interesting is that the Fed insists that this is not stimulus. Of course they would say that. Of course they don't want you to know that there is a need for one. Why would they tell us that this is stimulus when they just spent month and month telling us that the economy is doing just fine? But the size and persistence of these operations have since reignited debate over what's really happening in short-term funding markets and how this affects the United States economy as a whole. Now, according to this chart that you see on your screens right now, the December 30th operation was only smaller than the emergency intervention seen during the pandemic. In other words, everything looks fine until it suddenly isn't. And that's the key point. Repos actually spike when institutions need immediate liquidity to meet collateral requirements. And this can be tied to commodities exposure or balance sheet constraints that sort of intensify, typically at a quarter end or a year end. Now, at year end, as we just saw, due to regulatory reporting standards, U.S. banks are required to meet certain regulatory requirements, certain standards, and so the Fed becomes the lender of last resort, whether it wants to admit it or not, because banks are typically not motivated to lend to one another at this point in time. So what the Federal Reserve just did is ongoing liquidity, support for the United States banking system, because demand for Fed repos stayed elevated. It actually remained elevated throughout the month of December. The truth is, the reliance of the United States banking system on the Federal Reserve credit facilities is rarely a sign of comfort. It is not what they do when they are confident and when they have positive forecast, so this is not a good sign. It usually reflects caution and a lack of positive outlook moving forward. What makes this more interesting is what's happening beyond repos. The minutes from the FOMC latest meeting revealed that the Fed is actually preparing to restart outright Treasury purchases under what it continues to call a reserve management program. Over the next 12 months, the Fed could buy up to $220 billion in Treasury securities to ensure, quote, ample reserves remain in the banking system. So in other words, they are concerned about the United States banking system, and now they're actually, they're purchasing Treasury securities to manage this effectively collapse in a slow motion again. The Fed is adamant here this is not QE. The Fed says these purchases are purely technical, they say, and they are designed to maintain control over short-term rates. Jerome Powell himself emphasized that the buying has no implications for the stance of monetary policy. But let's be honest, labels don't change mechanics here. When the central bank buys government bonds, what happens? What happens is its balance sheet expands. We know that very well. It happened during COVID. Liquidity enters the system, and in this particular case, the pace of buying is regarded by many as a red flag. I would say this is a red flag, and it is a very unusual sign. The Federal Reserve announced that it will begin purchasing around $40 billion in Treasury bills per month starting immediately. And so that pace actually exceeds the current runoff of mortgage-backed securities, which in practice means that more liquidity is being injected into the economy. And of course, the financial system will react accordingly. The shift comes right after the Fed officially ended quantitative tightening. Since 2022, the central bank had been shrinking its balance sheet. It allowed bonds to mature without replacement, and that process reduced the balance sheet from roughly $9 trillion to about $6.5 trillion. But in late October, the Fed pulled the plug on QT just when the signs of liquidity stress began to emerge. So here we are officially in a higher for longer rate environment. And unofficially, I would say we're just watching liquidity rise again. The FOMC minutes made it very clear that policymakers are in no rush to cut rates. Trump wants to cut rates, and he might have the support to do it. But the Fed in general is not in favor. Most Fed officials believe that inflation must continue to decline before easing can resume, and yet at the same time, global liquidity has hit a new all-time high, according to recent data. Global liquidity has increased by roughly $490 billion. This isn't coming from one source, but several sources, and there is a clear disconnect, as we can see the disconnect may be the defining feature of the current economic cycle. On one hand, we have liquidity. Liquidity is rising on the other hand. Policy rates remain rather restrictive, I would say, and it is unclear what happens next. The Fed insists that it's not easing, even as it injects billions of dollars through repos, as it restores Treasury purchases and holds balance sheet contraction. But critics argue that this distinction is very semantic, and what it's doing is, in fact, it is injecting liquidity as it intends to. The real question isn't whether this is QE. It's whether December marks a turning point and what comes next. When central banks move from draining liquidity to adding it, even quietly, the direction does matter. So stay tuned. I will continue updating you here on YouTube, as well as on my Substack and Patreon. Thank you so much for watching. As always, make sure that you support my work. I appreciate every single one of you who has become a paid subscriber on YouTube, on Patreon, or Substack. Thank you so much for your support. Have a great rest of your day, and I will see you back here tomorrow. Bye for now.